Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education at Schwab. And this is Long Verticals and Diagonals. And today we have a good one. We're going to be talking about trading the 50% rule for faster exits in a volatile market environment. We're going to be discussing this rule, sometimes referred to as the half-in-half rule. I think it's going to be a great discussion. It is all about managing profits, but doing it more rapidly, maybe more responsively in a rapidly moving market. So really looking forward to this one. Before we get to that discussion, I first of all want to say hello to everybody out there. Great to see so many familiar names out there in YouTube already. Hello there, Will and Kevin, Greg, Selva, Andrew, Ray, everybody else. We always appreciate your attendance and your contributions to these discussions. Thanks for joining us here week after week. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, we'll enjoy the presentation, but be aware that you're invited to join us in the live discussion. This webcast series goes out live on Thursdays, and it kicks off promptly 11 Eastern. We'd love to have you here in the live stream audience if you'd like to join us. Also, I want to let everybody know that my very good friend Connie Hill is going to be hanging out in the chats with us. She's going to be addressing any questions that I can't get to. Thanks for being there and having my back there, Connie. And also, Connie and I would like to issue an invitation to everybody listening. If you have an account with X, give us a follow there. You should be following your favorite presenters on X. It's the best place to connect with those presenters in between the live streams. You can find Connie there at Connie Hill CS, and you can find me on X at Cameron May CS. But let's get into this discussion. And as we do, of course, we need to pause to consider the risks associated with trading. Certainly applies to options. So let's bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so let's set the agenda for the day. So today we're talking about managing trades more rapidly. And last week we actually had a trade, spoiler alert, placed a trade last week. It's already over, where we implemented this profit management strategy that I'm going to be talking about today. So we need to, first of all, go back and have a look at our existing positions and the one that we did last week. Then we're going to take a look at current market conditions as if we need a reminder of the sort of volatile markets that we're dealing with. And then we're going to plan and place a new trade using what's known as the 50% rule, otherwise known as the half-in-half rule. You'll see why it carries that title sometimes in just a few minutes, but it should be a really good discussion. Let's go right to the Thinkorswim desktop platform and look at our current positions. So right now we have 5 positions. They're primarily bullish. Some of these are still playing themselves out. That's why most of them are generally struggling, not surprising the way the markets have been behaving. But the first one is Amazon. So with Amazon, we have a long call vertical spread, bought the 185s, sold the 190s. We prefer to be above 190. We're not. We've actually slipped down below 185, but boy, the way the markets are working right now, may not be long before we pop right back up again. Let's look at those on a chart. So here's the position. We initiated this right here on the 27th of March. You can see from that point sold off. We prefer to be up here in this green territory. We slipped down all the way down to about 160. We popped up in sort of recovery mode, but today, floating just below our 2 strikes, the 190 and 185. We're trading right there at the 183-ish level. We'll see if we can continue to recover. There's still some time to do that. This one, we're going to let it continue to work. Next up, we have Gilead. So Gilead is a long call diagonal spread that we've been managing along the way. Let's say we're nursing it along the way because it's been kind of a sick patient. Actually, no, sorry, I was thinking about UNH. In any case, Gilead, we bought the 95 call some time ago, and we've been selling short calls against that. Here's where things stand right now. Bought our 95 call back here, sold the 100 and the 105s along the way. Those we had to close out to sort of get them out of the way as our long call was running up. So we closed those out for losses. We did take a profit, the 120 calls up at this level. We're currently in the 115 short calls here, and with this retracement, I think this is going to open up a window for us to take some profits out of that short call. Let's go look at those. Let's go to our monitor tab. Yep, our 115s. We sold those for $1.28. They're worth 10 cents right now. So we're sitting already above 90% of the maximum benefit that those short calls can provide. With these, let's wrap these up, and we may be actually even rolling down a bit. I wonder if we could get away with maybe selling the 110s here for, let's go, let's see, we do have an earnings announcement right there. What date is that? That's going to be on the 1st of May. How about we go for a late April expiration? See what we can get for a 110 contract. Let's have a look at that. Latest in April we can get, without stepping over that earnings announcement, is the 25th. Let's open that up. Maybe look at the 110s. Where do we go? I went way too far. Oh, it just took a little while to load. There we go. And it does look like we could sell for maybe around $1, maybe 105. Okay. And if we're closing out for 10 cents and then collecting an additional 105-ish, we're doing that for about a 95 cent potential credit. Let's do that. So we're doing the 25th of April, 110 calls. So let's go to our monitor tab, and we're going to right click on our short call here. We're going to create a rolling order and select the one item in the side menu here. It'll say calendar. That's technically what this is. When we're, if we were opening a position here with a short and a long call of different expirations, that would be a calendar, but we're actually closing one and getting into another. So in this case, we're buying back the 115s that we're already short and then selling the 110s for, it already has the 25th of April. We always want to check that expiration because it's not a mind-reading software platform. It didn't know that that's what we were going for. It just went to that automatically. It happened to coincide with what we'd planned. It looks like we might be able to get about that 90, I said 95 cents, 93. Let's say we're willing to do this for maybe a 90-cent credit. Now, when we submit this as a limit order, there's always a risk the order might not fill. But let's click confirm and send. We're going to sell this hopefully for a 90-cent credit on 3 contracts. So it would be a $270 credit minus commissions, would leave us with a minimum acceptable credit on the roll of 266.10. Let's send that off and see if we get a fill. I'm going to leave that up here in our working orders. There it is. We're asking for a 90-cent credit. Right now the mark is at 94 cents. I think we stand a pretty good chance of getting a fill here, but we're gonna have to monitor this for a little bit, see if that'll fill. But that's it for our Gilead trade. Let's move on to JP Morgan. Now this one, we have a long call vertical spread again. Bought the 260s, sold the 265s. We'd prefer to be above 265 in this market. Not going to get it. We're way down at 228. This thing has fallen from our initial, what was that, a 260 investment? And ouch, it's only worth about 12 cents right now. Now, this one we actually did 7 contracts initially, and when we had the first collapse in price, we took off 4 of those contracts, leaving 3. So we already took some lumps, but we managed to cut the loss by about half on those. So let's go to our JPM chart. Here's where we initiated that trade. The markets just decided to be uncooperative. We fell, popped back up. We took our loss right there as we rose up to a previous resistance. We thought, this might turn. Let's get out of some of these. And it did. And we've fallen, and there's just not much time left for this to recover. That's why it has so little value. Now, I've got to admit, it may be tempting for a trader to say, well, let's just, we've lost most of our money. Yeah, it's probably not going to recover before this expiration, but maybe it will. And maybe on that outside chance, we'll just leave that trade on. We could. But realistically, for this to get to its maximum gain, it'd need to get all the way up here. And even in these highly volatile markets, that remains an extremely unlikely and improbable outcome. Even getting back up to our lower strike is extremely unlikely, very low probability. The lesson here is it can be tempting to say, well, I spent $260 on this, it's only worth 12 cents, forget about it. And we sort of mentally abandon the trade. But let's put this in real dollar terms. As nominal as it sounds, these are still worth 12 bucks each. There are 3 of them. That's $36. I don't know about you, but if somebody were to reach into my wallet and take $36 out, I would miss that $36 and I would have unkind feelings about the person who took it from me. So let's not be unkind to ourselves. Let's close this up. I'm going to right click here and create a closing order, and we're going to sell this vertical for what we can get for it. Now, we may be able to pull 12 cents out. We might not be able to. Let's say we're willing to just settle for 10 cents. Chuck says, Cameron, when you call, when you took off several contracts, referred to them as a trim. Maybe, Chuck, you gave your position a trim. Yeah. But let's see if we can get out for 10 cents here. Let's click confirm and send. It doesn't look like our other order has filled just yet, but we're trying to get 30 bucks out of this. There's $3.90 still to pay in commission, so that would leave us with $26. It's still money. We're not going to abandon this trade. Let's send this off and see if we can get that to fill. Now, with some of these, looks like we filled at 12 cents, but it can be a little bit tougher when something has gone deeply in the money or deeply out of the money. It can widen the spreads between the bid price and the ask price. Those contracts tend to struggle with liquidity issues, and this is pretty real. Sometimes it can get harder to fill those orders. So not terribly surprising to me. This one up here hasn't quite filled yet. Let's see if we can get that fill. I might need to bump that down, but let's move on to our next position with Lowe's. This one's actually doing just fine. Well, this one's a long put vertical. We'd like to be below the lower strike, which is 230, and we're down there. We're down at 219. Stock has been coming down, along with really the rest of the market. So we initiated this trade right here. It initially wasn't behaving, but now it is coming down. We'll let that continue to work. This one has a little way to go. Let's see. What did we spend on this one? This one we spent $7.20. You can see the difference between $19.45 that we bought, $12.25 that we sold, $7.20 on a $10 wide spread. That leaves $2.80 that might be made. Let's do some quick math here. 280 maximum gain per contract times 5 contracts means the most we can make here is 1,400 bucks. We're at 750. So we're about halfway to our maximum gain. Now, had that happened quickly, this is a little bit of a teaser for the strategy that I'm going to be talking about for managing profits. Some traders may already take that profit. Since this one has actually emerged more slowly, notice we initiated our trade back here, March 12th, and it has taken a full month to get to the halfway point for our profits. With this one, I'm going to let it go. Okay. Jerry says, why not take the profit? We could, right, Jerry? So trades that are going poorly or well, the trader always has choices. One thing the trader might do here is take the full profit. I mean, take whatever they have at the moment and maybe realize that gain. As long as they can get out of the trade, we have an opportunity to realize some fairly substantial gain here. Or a trader might say, well, if I'm in multiple contracts, we're in 5 contracts here, maybe I take a portion of the profits and sell out of 2 or 3 contracts or 4 contracts, whatever, and leave some more on to hopefully go toward expiration and achieve maximum gain. Or they could say, I'm not going to take any profits. Maybe keep an eye on it on a day-to-day basis, because things can change rapidly, especially in these markets. And particularly when there aren't a whole lot of days left on a contract, yeah, I wish I had the luxury of having you good people sitting around me and we just watch our trades. Keep an eye on it. Can't do that. I'd like to talk with you all along the way and we can learn all along the way. Can't do it, so we're going to make a decision right now. And my decision is going to be, let's leave this on. For better or for worse, we're going to revisit whether that turned out to be the right idea or not. But just be aware there are pros and cons to each of these decisions that we've just discussed. With this one, I'm going to let these continue to work. And that finally brings us to UNH, which has been a crazy story. Jerry says, doesn't the size of your account make the decision for you? No, not necessarily, Jerry. And you might be thinking about, what about assignment? What about exercising these, right? If we're assigned on a short contract and we don't exercise the long, that actually can incur either a very large short stock position or a very large long stock position that can kind of throw a smaller portfolio out of whack temporarily till we, exit that big stock position, whatever it is. So maybe, but when both contracts are in the money, that's not necessarily much of a threat at this point, because even if the short were to be assigned, we could exercise the long right away, cover the stock position. It's not an uncovered position. If we wind up in between the strikes in a spread, yeah, that can make some traders quite nervous. Yep. And Jerry, actually, this next stock, that actually is something that I wanted to discuss with this next position. I said UNH has been a crazy story. So with UNH, back on January 9th, we bought a 520 long call. And we said at that moment, we're going to stick with this all the way through the year, see what happens. Okay. It's been an adventurous start to the year with our UNH long call, but against that position, we've been selling short calls. Sometimes profitably. Right now, nope. So, oh, by the way, net, how are we doing on this trade? You can see on the current position, we're way up on the long call, way down on the short call. We're actually underwater to the tune of $2,000 on the current position. However, along the way, we've actually made some profits. So let's go to UNH here. This is actually a break-even trade pretty much right now. Because here's our current position. Own the 520 long, short the 530. But previously, sold a 560, made a profit. Sold a 550, made a profit. Sold a 540, made a profit. You add those up, that's about a $1,900 gain. But right now, we have a $2,000 loss on our current position. That's pretty much a wash within about $100. But here's what's happened since we started this back here on the 9th of January. This is a bullish position. Well, for quite some time, not quite some time, but actually for a while, UNH was way underwater. These long calls had really dropped in value, and we had a bit of a consolation prize in the short calls. But since then, UNH has absolutely rocketed upward. That's really taken us from being substantially underwater to being right about break even right now. But with the way that things are currently sitting, to go to, was it Jerry, your question? Yeah, doesn't the size of the account make the decision for you? This short call, we have somebody that has the right to buy shares from us for $530. And with just this contract expires right here. This is why this red dashed line terminates right there on April 18th. It's because that's the day after expiration. This thing's about to expire, and with it being this far in the money, they have the right to buy shares for $530 that are worth $592. Yeah, those shares are $62 in the money. Okay, any short option can be assigned at any time. We have to be aware of that. But there are things that can raise the risk of early assignment. One of those things is going deeply in the money. Another one of those things is getting close to expiration. And guess what we have a confluence of right now? Deeply in the money contracts, close to expiration. So what are the odds of early assignment right now in our paper money account? they are 0. There's no early assignment in paper money. Nobody's assigning fake contracts early. Real contracts, though, in a real account, there could be substantially higher assignment risk. Now, even though that assignment risk is higher, it doesn't necessarily mean that it will be assigned early, because there's an element here I wanted to talk about with UNH. Let's go here to the position for the 17th of April. You can see the position indicator flag here. And we are short the, let me give just a couple more strikes here so that we can see this. The 530. But what I wanted to discuss was this column right here. I added a column called extrinsic. That's the extrinsic or remaining time value of this contract. And right now that's about $2.50 on this 530 short option. And you can see it'll bounce around quite a bit because of the spread. There's a big spread between the bid price and the ask price. But in any case, the reason why so many traders choose not to assign early even when they could is because this value is lost to that trader immediately. The remaining time value, the extrinsic value. As this gets closer and closer to 0, that probability of early assignment goes up and up and up. I can never tell you exactly what it is because it either happens or it doesn't. But for some traders, they may look at this extrinsic to try to get a gauge. How likely am I to get assigned? It's always just a guess. Could happen at any moment. Now, but what if we were assigned? Let's say that this position is not going to happen in our paper money, but let's put ourselves in the shoes of a real trader. We have an obligation where somebody has the right to buy 100 shares of stock from us for $5.30, and we might think that's okay. We could just buy the same shares by exercising our $5.20 call, buy those shares at $5.20. That preserves us from a big loss on the shares. Because if somebody buys the shares at $5.30 and we have to go buy them at current price of the stock, that's $593. That's a $63 loss. Ouch. Can you say ouch? That's an ouch. Still wouldn't make sense to exercise this $5.20, because in order for us to save ourselves from a $63 loss, we would have to give up the remaining value of our long call, which is $142. Tell me, is it a good idea to spend $142 in an effort to preserve $63? It's not a good idea. Nope. So the take-home lesson here is if we were to get assigned on this, somebody were to buy 100 shares from us, it would leave us in a short stock position. Probably, almost certainly, the best way to handle that for that trader would be to just buy the shares, pay the $593. Yes, we took a $63. You call it a trim? Is that a haircut? That's going bald, right? But $63 loss, but now we still have this $5.20 call that's worth $142. So we're not feeling so bad about that. That's why we're not looking at a $6,300 loss here. We're looking at a $2,000 loss because the profits on our long are making up for the vast majority of the losses on the short. Anyway, so there we go. So that's our existing positions. I did want to talk about last week's trade. Last week, we took a position on Microsoft. Here's what we did. We bought a 390 long put, sold a 385 short put. That we initiated that trade right here. That's a bearish trade, and it had the potential, if everything went well, it had a theoretical maximum gain of $1.50. We spent $3.50 net on that $5 wide spread, had a $1.50 gain. Well, we discussed last week, some traders, if markets are moving rapidly, they may be happy if they can make just half of their gain, but do it quickly. So what we did with this trade, let me go to our monitor tab and we can go to the account statement. Here's the trade right here. So paid $18, received $14.50. There's a $3.50 debit that had the potential to move up to a $5 value. But we decided, hey, if we could even just pull out $4.25, getting halfway from $3.50 to $5. Let's just close out of this. So we put in an order to do that, and guess what? This is the fastest trade I may have ever done in one of these webcast series. Within a few hours, it did that. We got halfway to our maximum gain. Our $3.50 investment was worth $4.25, and it closed out. And so this is sometimes referred to as the 50% rule. In other words, we calculate how much we can make on a vertical spread, and if we can get an unrealized gain of at least 50% of that maximum amount, and we can do it quickly, some traders will just take those profits. So what we need to do is define quickly. So for some, they may say, well, with this trade, the way that we structured it, just to revisit history, we go to the trade tab here. So this trade was placed for the 17th of April, which currently has 7 days on it. Last week it had 14 days. So, but for some traders, their definition of quick profits is if we can make at least 50% of the original gain in less than 50% of the original time frame of the trade, hey, that's actually speeding up the rate of profits if we can make it, right? Well, let me just say it this way. We just made, pardon me, hold on a second. But we just made $75 per contract in a few hours. Now, had we held on to that trade, it carried the potential to make $150 in 14 days. If we had our druthers, would a trader prefer to make $75 very quickly or $150 over, let's say, 2 weeks on a regular basis? I think the math would say, oh, let's go for the faster profits, even though they're smaller. That's the concept here. Now, what I'm not going to say, there's no guarantee that the profits will actually be realized. But in a rapidly moving market environment, some traders make this plan recognizing, hey, I probably don't want to sit out all of this volatility for the full duration of a trade. Let's just try to do it quickly. All right, so let's plan a trade and see if we can put this 50% rule, or this half, in other words, half of the profits, in half of the time, the half in half rule. So our example trade today, this is a trade, we actually did a profitable trade on this just recently. Let's see if we can go 2 for 2. I'm going to go to NVIDIA. Oh, actually, we didn't even talk about the markets. Let's talk about that first. We'll come back to NVIDIA in just a second. But the markets, yep, here's that volatility that I've been talking about. And there's been some interesting proportions in that volatility. For those that use Fibonacci retracements in the planning of their trades, I want to start off with a review of the last 3 years. The last 3 years have been great. From these October lows up to these February 19th highs, how far did we go? We went from $3,500 index to a $6,200 index. Nearly doubled, not quite. And then we started this selling. Ooh, that's been rough. How much have we given back in these weeks right here relative to these years? Well, I'm going to go up to the top here and click right at the peak and draw Fibonacci way down to these lows, and click again. And if you look at these, at this week's lows, it actually reached right down to a 50% give back, a 50% retracement of all of the gains of the last 2.5 years. Now, for Fibonacci traders, actually, that may not come as much of a surprise. A basic assumption of Fibonacci traders is that when there is a strong move in one direction or the other, it's not uncommon to see half of that distance retraced. I know, Carol, it's tough to look at NVIDIA. It's also tough to look at SPX, right? Yeah, that's how rough this has been. My apologies. I know it's not fun to look at. Well, let's look at what's also happened more recently. So let me take this fib off, or should I leave it on? Now it'll get cluttery. I'm going to take it off. You've already seen it. Let's go back to the 1 year chart. And on this retracement, we've had a strong, in this case, instead of a strong run up and giving back 50%, now we've had a strong run down to these lows that reach down to that 50% low on the yearly chart. So I'm going to come down to these lows and click down here and move up to the top up here. And look at these last 2 days. As rapidly as we surrendered 2.5 years worth of gains, how quickly have we recovered 2.5 months? Is it 2.5 months? We'll call it 2 months of selling. We actually shot back up 50%. Now that fib might feel good. Ooh, wow! Yesterday we were feeling, hey, we got halfway back to those all-time highs in an eye blink. Yeah, but sometimes that can be seen as a resistance level. So our Fibonacci trader might say, hey, this was just maybe the start. I mean, it was a nice little bounce, but we could start heading down again. That's kind of what we're doing today. Dave says, do you use the tails or this is bodies for fibs? So without getting too far into the weeds with Fibonacci's, there are two schools of thought. Two schools of thought there. You'll see me typically use the absolutes, the extreme lows and the extreme highs. Not everybody does that. So there could definitely be some that would say, let me just activate this drawing. Maybe they pull it up here because there were a few more touches at this level. Still landed in between the 61.8 below the 50% level. But yeah, that wouldn't be an uncommon way to do that either, Dave. But let me just remove that drawing. So where might things be headed from here? Well, right now, we're giving back territory fairly quickly. We're going to be doing a bearish trade, but managing its exit. If profits arise, we're going to get out of them quickly, okay? And so our trade is going to be built around NVIDIA. So what's been going on with NVIDIA? A couple of things. We've had a strong sell-off recently. It's interesting because we had a strong sell-off right here. Look at this peak, down to that low. How high did we recover? Came up just around that 50% level and then sold off again. But even if let me just activate this drawing, pull this down to these lows. Wow, look at where this touched before it gave back territory again. So for our Fibonacci trader here, they may see this is like, it might move on down to the next level of Fibonacci low, could move back down to the 0 line. One other thing of note, if we look at the long term on NVIDIA, let's go to the full 12 months. I'm going to go from these highs up here down to those lows down there. 50% is turning out to be kind of a theme for today. From the 12-month lows to the 12-month highs, how much? Well, we surrendered almost down to those lows again, but we popped right back up to that as our new potential resistance. We'll see. So let's just go on the assumption, right or wrong, that maybe we're set to go down a little bit further. Let's clear this drawing set. We're going to put on a bearish trade. We're going to put on a long put vertical spread here. And what our trader might do, should I do this? 50% is kind of the theme for today. 50% retracements on Fibonacci's. We're going to do 50% profit management. Shall we go at that 50 delta? Let's look at a contract. Let me see our chart here. Okay, no earnings announcement coming up. Let's go to our trade tab. And I'm going to go out here to the 16th of May expiration. 36 days until expiration. And for this trade, let's structure it right at the money. The stock's trading, that couldn't cooperate much more. 107.5 would be right in between two strikes here. Let's maybe buy the 110, sell the 105 vertical spread. Okay? How much is that going to cost us? Let's come here to our spread single. Let's change that to vertical. The 110, 105, yep, looks like it's going to cost us a little bit shy of 2.5, maybe 2.25. Let me click on that ask price. And if let's say we're willing to spend 230 for this, okay? if we spend 230, looks like it might cost a little bit more. We'll see. Anyway, if we spend 230 on this, one contract would be a $230 risk. We typically risk around $4,000 per trade, so it's not going to quite be 20 contracts. I think we're going to wind up with about 17. Let's see. $4,000 divided by $230 per contract is going to be, 17. Let's do 17 contracts. Now this right on up, we could have just typed in the number. I'm being a little bit lazy here, clicking the buttons. Anyway, let's see if we can buy these for $230. If we're able to buy these put verticals at $2.30 and it's a $5 wide spread, how much is left over for potential reward? For those of you who are familiar with long verticals, if we're spending $230 on $5 wide, this could become a $5 value. That's a $2.70 profit potential. So let me map this out, okay? Our theoretical maximum gain. And my apologies, it's always faint here. Let's make that a little bit bolder. It's a $5 wide spread minus a $2.30 cost to set the trade up. That leaves us with $2.70. Now, to impose the 50% rule, that would be exit if value rises to what? Well, if $2.70 is the most we can make theoretically on this trade, half of that is going to be, or 50% of that is going to be $1.35. So if we bought these for $2.30 and we're looking to make a profit of $2.35, that would be what, $3.65. Now, it's not just if we can sometime before expiration get to $3.65, but actually if we can get there by or before the halfway point between now and expiration. When would that be? 36 days is expiration. We'd like to see this happen in half that time, 18 days out. What would that be? So we're sitting, that would be it's April 10th right now. That would be April 28th. So half our potential profit by April 28th. How do we put that into practice? Well, here's how we can enter that order. Let's come down here where it says single, and we're going to change this to a first triggers sequential order. And if we're buying for $2.30, we want to sell for $3.65, let's right-click on the original order and create an opposite order. Now, by default, this is going to put in an order to sell right away, $2.30. Buy at $2.30, sell at $2.30. It doesn't sound like a good idea to me. Let's say buy at $2.30, sell at $3.65. That's going to be our limit. I'm going to make that a good till canceled order, but I also want to put on a time requirement here, because it's not just sell at $3.65, but only sell at $3.65 if we can do it by April 28th. That's an order condition, and we can add that condition over here using our little gear. So on this condition field, if you haven't ever used this before, let's cancel this order on April 28th if it hasn't filled by that date. So putting this all together, we're putting in an order, hey, I want to sell these contracts for a net of $3.65 if I can do it anytime until I cancel this order. And specifically, I want to cancel this order on April 28th. If it hasn't filled by then, we'll just hang on to it and see if we can realize some profits beyond that. Now, we're not going to be ignoring the downside on this trade. We're going to be keeping an eye on this position as the weeks progress, but we're not going to be automating the exit either. In this case, we're going to make decisions, if the stock starts to rally, if it goes up above resistance. I want to have those discussions in real time. But this is how a trader might automate the process of the implementation of this 50% rule. In other words, the half of the planned profit in half of the planned time. So let's click save, and we're going to click confirm and send. Okay, so here's what we're doing. Buying 17 of these verticals. Have these prices moved on as much? I'm not sure. We're going to see. Buying these verticals at a 230 limit, selling at 365 if we can sell at 365 before the 18th or the 28th of April. Okay. Now, there are commissions on this trade to get in and to get out, so we need to bear that in mind. But let's send this order off and see if we can get filled. Okay, we did. We bought it at 225. And now we'll just see if we can get the other side of this, realize a profit before the 28th of April. All right, so let's do a quick check here. Did we get both of our orders filled? I think we did. Actually, let's go back here. Working orders. Now this one, it's being stingy on us. This diagonal spread, we wanted 90 cents. It's now only 85 cents. All right. Let's see if we can get out of this. Look at it's running away from us. 82 cents. I'm going to right click here, cancel and replace that order. Looks like we're going to have to, yeah, look at the spread there. It literally ran from us. I might have to back off here and say we'll settle for 70 cents. Even that may not fill at this point. This is one of the realities of trading options that have either gone deeply in the money or deeply out of the money. Let's send this order, see if we can get out for 70 cents. There we go. All right, sold at 71. All right, but that trade is done. And guys, we've accomplished what I set out to do today. We today wanted to discuss this thing called the 50% rule, or the half in half rule. Sometimes used by traders in rapidly moving markets. With our NVIDIA position, we're just going to be looking to see, can we get at least one strong move? And actually, it started to fade already. That was a white candle just recently. Anyway, but we'll see if we can get that move in that direction. But we've looked at our existing positions. We've taken a look at those volatile markets again. We've planned and placed a new trade using that 50% rule. This is what we do on Thursdays. If you enjoy these discussions, I hope that you'll put it in your calendar to join me each Thursday for our discussion of long verticals and diagonals. I have other webcasts throughout the week, though. You're certainly invited to join me in those as well. But I'm going to let you go and enjoy the rest of your Thursday. But before I do, I want to also remind you of resources that you have at your disposal. Number one, first thing, to use things optimally here on YouTube, make sure you're subscribed to our YouTube channel. You can go down and click on the subscribe button right now if you haven't done that. But YouTube is where we house our webcasts that have already been delivered. You can find our playlists of our previous webcasts. What you would do is, after you subscribed, go to YouTube and search out Trader Talks Schwab Coaching Webcasts. And right here on our homepage, you can find our playlists for this series and for all the others. Not all of them, actually. There are a couple of series that aren't posted here, but the vast majority. You can join our live streams right there. Also, make sure that you're following me and Connie on X. You can find Connie on X at Connie Hill CS. You can find me there at Cameron May CS. So let me just show you that, because it's important. On social media, make sure you use exactly this spelling, at Cameron May CS, because there are other accounts that can be similar for innocent reasons, other accounts that can be similar for nefarious reasons. You always want to make sure with social media you know exactly who you're dealing with. And this will make sure that you're dealing with me. All right. Also, thank you to everybody that's already clicked the thumbs up. Click the like button. I can see 140 people watching right now. 39 people have already clicked the like button. That's definitely appreciated. It's a nice pat on the back for the presenter, but it also gives my webcast a boost in the YouTube algorithm, helps more people find these discussions of things like the 50% rule. And I also didn't see a survey, right? No survey today, but we always like to keep an eye out for those. But in any case, everybody, thanks for giving me your time today. I will see you again next Thursday or in one of my other webcasts. I'll also look for you on X, but whenever I see you again, till that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.